Good afternoon, everyone. BC Richfield and Pedma coming to you live. The time in London has just gone 4 p.m., which is UTC. Welcome to Congress Day 4. If this is your first webinar, if you've been enjoying the rest of the content available today, welcome to this particular session where I'm really excited to introduce the ideas and principles around indicators and how we can utilize them in our trading. For that, I have my wonderful, super smart co-host, Mr. Pedma7 over here. Pedro, how you doing, buddy?
I'm doing great. Let's get this going.
Awesome. So, what we're going to do is we're going to look through a few typical indicators. We're going to introduce you to bits and pieces like the RSI, moving averages. We're going to take a little look at BPRO later on as well, and I'm going to show you how I use these indicators as part of Confluence, right? Or how you can look at strategies around it. But the most important thing, in my perspective, is the disconnect sometimes between the way that indicators are used. A lot of people are looking for this kind of silver bullet, right? Which is, I just put these indicators on my screen. It's going to tell me when to open and close trades. Those kind of things exist, and there's ways that you can create these dynamic indicators like we've done with the Burbicator Pro, right? But at the same time, you still need to have an understanding of market dynamics, how markets move, cycles, whether you're in an uptrend, a downtrend. Spotting all of these things are key. So while I'm going to give you a basic introduction to these indicators, what they are and how I would use them, what Pedro's going to do is going to be far more in depth. And we're going to actually look at the statistics behind these indicators, right? So I'm going to start off just by sharing this with you guys. And guys, as we go through this, if you've got any comments, please do throw them in there. If you've got any questions or any specific indicators you'd like us to take a look at, we'll very much try and do that for you, okay? So if you guys can all see my screen on there, yeah, perfect with the RSI. What we're doing with this one, guys, is let me make this a little bit bigger so that you can see it. Now, if we focus just on the RSI for a second, what we see here, we've got these lines. So this top line here, which is for a standard setting, is on 70. And you've got the bottom line down here, which is on 30. Now, you're looking at overbought above that level, right? So above the 70 line, and you're looking at oversold below the 30 level. Now, the way that I particularly use this is I'm looking for confluence from the RSI for two things. One, if I'm in a trade and I'm looking to go long, yeah, if the RSI is up here, I'm looking at that in the way that it might not be the best time to go long, right? If we're looking in an area where we might be looking for the market to cool down a little bit before the next leg up, then it's quite common that you'll see the RSI here up in overbought. And it's in the name itself, right? Too much buying, it's a little bit overextended, we may get a correction. Now, that's not to say that if you just went in and you started buying when the RSI is down here and selling when the RSI is up there, that would be a successful strategy. But in its simplest forms, that's one of the key areas we can use it for. The other area that I use it for personally is looking for divergences, right? That's where our eyes are telling us one thing with the chart, but the market might be telling us something slightly different. So if I put this back on here, and I'm going to pop this to a daily very quickly. Now, if we're talking about basic support and resistance, yeah, then if we're looking at this, and now let's just say, for example, we're looking here, and we've got a clear point of resistance here, okay? So we've got these highs here. We can see there's something that's clearly stopping the market here. Price trades away from this. Where to? Down into these lows. All right. So let's just mark up one of these just as an example. So we've got our support down here, our resistance up here. Now I've done that on a daily scale, right? But now if I drop down onto, say, a 4-hour, this is where we're going to start including the RSI a bit more. So if I'm here, we've got the top of the range here, the low here, or our resistance up here and our support down here. Now, when price interacts with a key level, and this makes up a big part of the way that I trade, okay, is I'm looking for reversal or continuation at specific levels, right? So we've clearly got resistance here. We can see where the market's been stopped here, here, and here. So as price develops and comes into here, once we set that as our potential support and we can validate that as price then moves away from it, as it comes into our area of interest up here, into resistance, well, as this comes in, I'm thinking to myself, well, what can I add as extra confluence to make me think, well, is price going to come up here and continue its move up? Or are we going to get a rejection here and price to move further down? And what we can see is as we use the RSI here, we can see that the RSI is up in that overbought region that we discussed, yeah? So for me, that can act as a little bit of a red flag. I'm thinking, okay, if momentum's stalling as we're getting up into here and we're up in overbought, then there's a high chance we could have a correction. Now, when we then come back down with inside the range, all right, and we look at this on lower time frames, we can then look for price action to come back in here, break structure. Then we say to ourselves, well, our likely destination is the next port of liquidity, which sits under these lows. So as price is then coming down and we get to this level, once again, we're asking ourselves the question, are we looking to reverse here or are we looking for continuation lower? And again, no silver bullet, guys, but if we look at this area down here, right, and let's make this green, then when we do the same thing down here on the RSI, we can see, right, that as we get into this area down here, we've got the RSI and oversold. This is telling us that in terms of that strength, that relative strength in the market, maybe that's not the best time to go short. So then we can look while we're in here and you can look to take some scalp longs, some day trade longs. So I know that seems really, really simple, guys, but for me, that's really how I'm using the RSI if I want to bring that in for confluence. That, and obviously our divergences as well. But what I want to do is go beyond the way that I'm thinking about these things or the ways that I've tested them, and I want to hand them over to an expert in this who can tell me actually what is going on with them. So, Pedro, if I just remove my screen and hand over to you, tell us a little bit more about the RSI, man. What's this from a statistical perspective? What are we looking at here?
Of course, Chris, and you mentioned something very very important, that you said you don't look at them from an alone basis. You can never look at the RSI. Let's say if it is overbought, it means that you must sell. You look at them from a perspective that if it is overbought and if the market is in our direction and if all those criteria that we have tested together all confluence together, then we take a position that we know what is the statistical probability of that happening. Because if you are taking positions based on only one indicator data, it's not like you said, it's not very good, because if it was that easy as following one indicator, everybody with a simple computer would do it, right? So let's test this probability. So what I've done here is we can run a simple simulation here with PineScript on TradingView, and you can set up a simple strategy. Let's test a simple idea. For example, if we use an RSI that we are talking about with a 14 length, and if you tell the computer that if the RSI is above 70, so it is an overbought position, and if you buy, so if you get a signal that the RSI is above 70, you buy, meaning you do the opposite of what we are talking about here. And I'm going to show you why this is. And if you take if your exit position is when the RSI goes below 30, signifying weakness, you sell your position. If we save this and now we show it, we show it on the chart, you can see over the long term, and you'll see why I put this up. Over the long term, you have made money. But why? Why is this? Because we are not differentiating between regimes. What Rhys was saying about the 4-hour chart, if it is overbought, we should not be taking positions on the long side, and that is true. Because what I'm doing here is looking at this from a perspective of if the RSI is overbought. For example, in this, look at this position that we were talking about. Here it was already overbought above the 70 level, and you would sell when it reaches the 30 level. This works great in a bull market, like we've seen back in 2021 and 2020, right? It works great because the market has this persistence of price, these trends following basis. But once you start crashing, this gives you more fake outs than actually. For example, back in July, you are getting faked out of the position all the time, like Rhys was just mentioning. So if you actually apply a regime, let's say the 100 moving average, so let's put here 100 moving average, it is a TA.SMA and you apply to the close, and you put a length of 100, and you say that your trigger is only when price is in a bullish regime. So if close is above the SMA 100, exactly, and you apply that. Let me see. Let's 100 on a 4-hour time frame for 812. Let's do a representation of the daily 100 SMA, which should be around a 600 SMA. Let us see. It is simpler than me coding from scratch. Now you are only trading the bullish regime of the market. Of course, this needs more analysis, but you have to separate indicators by different regimes. If you use the 100 daily moving average, you are not trading much. You are not getting faked out. So you need to apply each indicator based on its context. You can't just apply an indicator and say that it works everywhere. You must be very specific. If you apply it to different regimes, it will get different results. Rhys? I
just
think
realised I'm on mute.
yeah, no
I
problem.
was so excited to jump in then, Peds. I forgot to take it off mute. But it's amazing. So you're coding that into PineScript, right? And you're using that to test these theories, right? So as you're adding that in, you're adding the 100 SMA and you're saying, okay, you're basically then limiting yourself to saying you're only trading the bullish trends when you're above that. Yeah. So then you're
Exactly.
taking out all those elements where you can get kind of faked out all the time. And I think one of the things that I see a lot in trading is people move a lot inconsistently between different indicators on different time frames, right? You know, there's the old adage that if you use the 50-day, 50 period moving average on the daily, then, you know, price is bullish above it, price is bearish below it. Yeah. Now,
Exactly.
that's all well and good, but you obviously get those points of chop where price, you know, moves up and over it. But then if you're combining that with the right, for want of a better term, for the right set of ingredients, right? You're allowing the moving average in there. You're then making an allowance for the RSI. So as we can see up here, right? So in your real trends, it really is fantastic. You get these kind of deviations, if you like, which you see in that kind of point there. But actually, overall, you know, it's fairly reliable, right? But you would have to have such a long-term trading strategy. However, where you see it become less reliable is in that kind of sideways parts, right? Those compression, those extended ranges where when we're looking at the trend, you had a couple of deviations, fake outs, if you like, that have come up, but then they've reverted to trend. In this kind of section in here, you could be getting yourself chopped up, you know, every which way. So
Exactly.
what would you do? I know you build sort of systems over the longer term. How do you allow for that? How do you make an allowance for that? Are you bringing the RSI into this to bring that out? Are you looking to add a second moving average? What would be your process?
Okay. So you have to be careful when doing such long-term analysis,
Mm-hmm,
because let's say that we start looking at a chart, okay, and we see here a few fake outs. For example, we see this fake out
mm-hmm,
here, and we start to think, how can I avoid this fake out?
mm-hmm,
In trading, when looking at data, that is a very bad way of looking at the market. You can't think
mm-hmm,
like that, because if you are looking at this point and trying to avoid this specific trade, you are
mm-hmm,
you are it how can I put this? You are trying to avoid the unavoidable, and you will end up fitting the system to a data that won't happen again. You need
mm-hmm,
your system to reliably trade. Let's say since 2011, it doesn't need to be 2011. It needs to be the most amount of data possible,
mm-hmm,
and you need your system to survive out of on that data and the data forward. So I don't. I don't like the idea of trying to avoid all choppiness, because
mm-hmm,
choppiness is natural and it will occur across history.
mm-hmm,
What you want to do is try try your best, to ensure that you are looking at a specific data and you like the way that your system works on that data. For example, if I were to build a system, I would grab the initial part of this data, let's say from 2011 to 2014, 2015, and I
mm-hmm,
would build a system on this part of the data, and then I would extrapolate this system into the remaining of the data. Because if your system works here, if you build a system that works here on the initial part of the data, and if you extrapolate it to the remaining data and to other assets, and if it works, you are ensuring its survivability. So I'm way more focused on the system surviving long term than to avoid some short-term shoppiness. Of course, I don't want to be trading like the long side when the market is like this going down. That's why we add moving averages, we track regimes in different ways to try to our best to stick to the regimes that the system better performs. But going to trying to avoid all short-term choppiness can be very misleading. And then when you put your system to work live on the live market, it will not work into the future.
I think as well, what resonates with me about that point, Peds, is that when you look at trading in general, I don't build systems. Very thankful to to have such talented team members around me like you that introduce me to these concepts, right, and how you implement this. But I think the one parallel that I can take from that into day trading or swing trading or just regular actual chart trading is that it's this aversion to loss. Right, so people kind of don't want to take the losses. There's never going to be a system that will win all the time, right? And what I think sometimes what leads to that is maybe a lack of testing or maybe understanding the system over a long period of time. People will have a system that works really, really well when it's trending, but they don't like trading bear markets. So then they're either trying to use a system that isn't very well set up for that, or they're trying to use a trending system in a ranging environment, or they're moving just sporadically between different systems, between different indicators, trying to find this perfect match. Yeah. And I think what you find with people that do that is that they just don't, it's very difficult to get consistency that way, right? You have to take the losses, excuse me, you have to manage the drawdowns, right?
Exactly.
Which, is definitely something I've learned from you. There are a lot of system builders and that use that terminology as well. And when we look at just the data that's in front of us here, if you're comfortable with that, right, and you can implement it correctly, then if you've got the patience and the willingness and to test this over time, then I think that the key thing or the key takeaway for people here really is that you have to accept the losses, you have to manage the drawdowns, and that actually all of trading is something that takes a long period of time. I think one of the really big misconceptions in this space is that people look to come into it and make really quick money. They think like, oh, I can do this, I can invest in X amount of coins, or these traders make loads of money really quickly. It's not. It's a grind of an industry. It's something that takes a lot of commitment, a lot of passion, a lot of education, and constantly trying to better yourself to understand these market dynamics more intimately, right? So if you can come to peace with that and accept that you're not just going to have 3 wins every time and then 1 loss and 3 wins and 1 loss, you might go through a spell where you have multiple losers. You go through spells that you have multiple winners. If you can deal with that inconsistent nature of the market, yet apply an almost machine learning way of thinking, then I think that would help most people in the long run. So if we look at the chart that you've got there, Pedro, and you're talking about, look, this huge build up, right? You've got the moving average here. Now, if we have a system that allows us to pick long triggers whilst we're above that, and another system that allows us to pick our short triggers whilst we're below it, over time, that's going to add up, right? And you're going to, you're going to do it. So, what other indicators do you specifically? Because I know that you test a plethora of different indicators, strategies, methodologies. You back test them until you basically break these things, right? So, what do you? If you were to say right now, if our viewers are interested in this, what would be your setup for this? If we're allowing that moving average, and then we want the extra indicator or an extra kind of trigger mechanism in there, what would be your view on setting that up?
Okay, what would be if let's say if someone that is watching wants a simple long-term system? Is that what you're saying, sorry?
Yeah, exactly. Yeah. So just for people that have an interest in this to say it, and obviously the moving average here looks really, really attractive, right? Because we can see it's helped us catch that massive uptrend. It catches a really good part of that corrective move down. It then catches the biggest parts of the move up. So you would think if you could apply, and I know we have to test data further back than that as well, right? But if we allow for that moving average, I suppose the question is, what would you then look to add to this to help you maximize when we're trending and obviously then when we're trending down.
Of course. So there's a bunch of things you can do when looking at a trend following system. The first thing you have to look at is always strength indicators. Either RSIs, you have Bollinger Bands, breakout of Bollinger Bands, breakout of daily bars. For example, you want a breakout of the past 50 candles, something like that. You want a breakout for every trend. You want a breakout, and we are here talking about trend following systems. If we were talking about a mean reversion system, like you were talking at the beginning, that was very correct. You want to look at the opposite of what we are doing. You want to look at those ranging environments and try to short over extensions and long down extensions, right? It's the opposite. So, but what you are talking about here is trends-based systems. What you want always is, like I was saying, a strength indicator. That's the first 1 or 2 indicators. Let's say we want an RSI, and let's apply maybe a Bollinger Bands. For example, Bollinger Bands can be a great tool for this as well, and I'll show you how. For example, you want the RSI to be above 50, and you want to sell when price closes below the lower Bollinger Band. All right. So let's test that out. You have to code the Bollinger Band. Let me just grab here so we don't have to waste much time. Okay, instead of the Bollinger Band, let's test the most common one. Because the Bollinger Band, in PineScript, you require to do a bit more of coding, and I don't want to waste your time. Let's go with the Donchian channel. Donchian channel was the first indicator that I came above. It's just a maximum price. It was used from the initial turtles, the first trend followers that you will ever meet, that you'll ever know. If you are interested in trend following, you can't miss the turtle traders. So let's test the Donchian channels. Let me put here. Yeah, so the Donchian channels is basically a trend breakout system with the maximum high. So the higher band is the maximum high for the length that you choose, and the lower band is the maximum low, the minimum low for the length you choose. So we want a breakout above that band. So we'll code here the Donchian above channel. Let's put it is a TA dot highest, and we put a high. We want a highest high for the past 55 bars. All right. So if the close is above that Donchian, and if the close is above the SMA 100, let me just change here. We get a breakout. All right, and let's keep. Just for testing purposes, let's keep the RSI when it crosses 30. We get an exit signal. Yeah, this is calculating. Okay. Close. Sorry, and close. You have to use the past candle, because if you use the PineScript code won't work, because you are saying that you want a close above the current high. That never happens. So you get these results. Of course, you have no risk management here. You have a 60% drawdown. This is not indicated. You need to do some risk management tools after that. We are just looking at the system. But looking at the system, if you look at it, you will trade the majority of the trends. You will avoid the majority of the breakdowns. Let's say we even want to get more complex. Let's say you want to get out when it breaks the Donchian, the down Donchian, the down channel, with a lower resolution, with a 20 bar resolution, so you can extract more profit from the trend in theory. So you put here, if the close is below the down Donchian, you get out. Save. This will recalculate, and you get a 205,000 return. just by doing this and look at the drawdown, how much it has been reduced to 28%.
Right, and
Of
that was
course,
60 before, wasn't it? On the last one, is that right?
it
60%?
was, yeah, it was 80,000%. Now it's gone to 200,000. But before was 80,000% with a 60% drawdown. Yeah, exactly, 60%
60%.
drawdown.
Wow. Right, so that's a huge difference there, right? So as you're kind of, and I know this kind of flips a little bit more towards the more technical side of the indicators and that, right? But when you're thinking about that, then you're refining that down. So are you starting with a certain set of parameters like you did with the Donshin, right? And you're saying, okay, this is the parameters for that. But then you reduced that down a little bit, didn't you? You kind of made it a little bit more targeted. So would you stick with what you've got there? And I mean, because obviously as you test these things, right, what must be crazy for you guys? There's so many different indicators, so many different ways that you can kind of add these combinations together. But something like that, I mean, it's very, very impressive, right? You
Yeah,
know, looking at that, the way that it is, and how you can build that out. But I suppose the
and you
one
can,
thing about systems that aren't doesn't happen with traders is you're removing the human element, right? Like, you know, the anxiety you would feel before entering a trade, managing that trade to conclusion, right? You've got the statistics in front of you here. You would have an automation system that would be making these trades. I would imagine you would look to build it into an API, right?
exactly. Yeah.
Mm.
And as you can see, then you can test also on other assets, like for example the S&P 500, and it works because the S&P 500 is usually, it has been a trend-based asset.
Mm-hmm.
So
Yeah,
if you,
absolutely. So we just had a quick question here, Pedro,
yeah,
actually from Brian, who's come in, and I agree with him. Sometimes we get carried away in an industry where we have sort of like a lot, or you certainly do, but knowledge on the subject. In terms of breaking this down a little bit more simply, I think we can absolutely do that. So maybe looking at this in terms of why we're using that moving average, you know, you're using 100 period, or are you still on the 50 there, and then using the bands in the way that you are. Maybe we just have a little kind of quick breakdown of that for Brian. Can you simplify it a little bit?
of course. So that's a valid question. Sometimes we get carried away with talking about this, and we don't explain everything 100%. So
Mm.
this simple strategy, Brian, you have to look at the Donchian channel. We use the Donchian channels and we use the moving average. What is a Donchian channel? The Donchian channel is just the highest high. In this case, the higher band here, this band on the top, is the highest high for the past 55 days. All right? For the past 55 bars, we get the highest high. Why is the Donchian important? Because when you get a breakout above a significant daily resistance, so how do you classify a resistance? You classify a resistance by the highest high, right? If you get a breakout above the highest high, you get a significant break of structure, liquidity, everything. So you want to quantify those breakouts in a systematic way. One of the ways to quantify a breakout is using the highest point for the past few days, and then you combine then with a moving average to guide your regime. So you want to be in a bullish regime. You don't want to be trading down here, right? You don't want to be trading like when the market is crashing. You just want to be trading when the market is going up.
Mm-hmm.
So you use a moving average to quantify that, and you only trade above that moving average. Once you do that, you are putting the odds in your favor because you are trading with the tide of the market, tide on quote unquote, right? And you exit the position every time that it crosses the 20 Donchian, so the lowest low for the past 20 bars. And that way you can get a longer term breakout and a shorter term breakdown, so that your winners are smaller than your losers. And you get these results down here. It's
Nice.
not,
No,
yeah.
that's a really, really good explanation for people. I mean, because obviously we've got people really, really different stages of their trading here. People that are looking at this indicator use for applications within system building. Other people that are looking at them more from kind of like, you know, a charting perspective and stuff like that. So let's, before we continue on with this, let me share my chart for a minute and maybe show some people how I used to use moving averages, right? Away from the space genius that you're delivering over here, back to the real kind of simple, you know, nuts and bolts side of it. So, one of the things that I was really, really curious about, or something that fascinated me, when I first got into trading was looking at moving averages, because when you look at them on a certain time frame, a little bit like Bollinger Bands, they can really look like like they're magic, right? So one of the things that I used to incorporate in my trading a lot was on the higher time frames, I'm looking for moving average crossovers, right? So, golden crosses or death crosses, bull crosses, bear crosses. Basically, what I'm using on here, and let me just make these a little bit bigger so that everybody can see them. What I'm using here is the 20 and the 50 period moving average. The 20 period moving average is our green line, and the 50 is the red or dark pink line. All right. Now, I was always looking at it under the premise that when we get these crosses, so just start with this one here for an example, right? I don't know if you guys can see this clearly. Let me just zoom in a little bit. Now, what we can see here is while we're in this uptrend from down here, we have the 50 period moving average on the bottom, and then we have the 20 period moving average on the top. So the premise of this would be that when we get the cross, yeah, so as we can see as we zoom in down here, before we got that bullish cross, we had this bearish cross here, price action's going down, right? Now, when the 20 period moving average crosses over and above the 50 period moving average, then we see ourselves entering a bullish trend, right? And the idea is that every time we pull back towards the 20 or the 50 period moving average, we can then look to re-enter, or we can then look to re-enter on the break of the high, obviously in bullish terms. So how that would look like on here is price comes in, sets this low, gets a reaction off of the 20 period moving average, right? We're then looking at this high here. And then when price comes and breaks this high, we can then enter the market either on a pullback, on a retest of this area, or we can just enter as it goes above. We then get this impulse move higher. Okay, once again, price comes down, tests the 20 period moving average, but it doesn't close above the high, right? So we're not back into this yet. We then get a further deeper correction down to the 50 period moving average, for which we can see when we then cross it here, we're very much back into our bullish trend. Now, as Pedro was saying, these things, obviously, they're not a silver bullet, right? You can't just trade them all, and I'll show you why in a moment. But we can see the same here when we get this bearish cross, which is the 20 period heading beneath the 50 period, telling us that the bears or the shorts are in control of the market. Now, once again, we get the cross here, and then we're waiting for this retest, yeah? And then we can look to enter the market when we break below this low, right? So again, we're short in here. And this gives us a little bit of action as we go short. Then we see we hit this point of consolidation. Now, where it starts to get a little bit less reliable, and again, great in trending markets if we've got ourselves a trend-based system, is then when price starts to consolidate a bit. So let's look at this as our first example quickly. And we can see here a similar thing, right? So we come back to test this. We don't close below the low. We come up, test it again. Then we break down. We can see we have a bear cross here. We have a bull cross, bear cross, bull cross, right? When you're in points of consolidation, it starts to get a little bit choppy. And quick question here that we've got coming in, IMINIBI. We've got MA50 and 100. Yeah, so the green one, my friend, is the 20. And then the red one is the 50. All right. So I hope that's clear. So that's the green one is the 20, the red one is the 50. For anybody curious about this, I could not endorse enough how much to just go and have a play around with different moving averages. Take a look at it on the screen, see how they interact. If you've got any handle of PineScript as well, as Pedro's doing, then you can really start to add these in and then test them using the strategy tester on TradingView. But really, this is much more of a point to say, look, if you had the conviction and the belief, as long as you're willing to take the losses that you get in these choppy areas, right? So you'll get some wins, you'll get some losses, but these aren't ideal for a trend following system. But if you were to just follow it, if you were to code it in a way, or if you were that switched on that you were making sure you were that active in the trades, then I believe you would be making a lot more money in these trending moments than you would be losing money in these moments of chop. And what we can see here, just to bring this up with current price action, yeah, is that we can see again where we're in this kind of extended range, that these things start to get a little bit less reliable. But there's always ways to make allowances for these. And this is where Pedro's such an expert with this. So, with all of that, the real kind of simple basics that I've stripped this back to, Pedro, how would you go about kind of testing that? Would you look to test for the moving average crossovers as the trend, and then again looking for that strength indicator that you would bring in?
Yeah, so as you was giving this great explanation, Reese, I was already coding it. So this is the this is the already the crossover strategy that you are showing. So whenever you get a crossover from the 20 SMA crosses the 50 SMA, you get an entry. As you can see, let's take just one example of a trade. You would have taken advantage of the full trend in 2020 to 2021. Of course, this is one example. It doesn't make a trading system, and you shouldn't rely on one example. But if you look at the entire history of Bitcoin, it isn't. You may look at the returns and see that's a great strategy, but would you endure a 60% drawdown? I don't see it. You would be better just buy and holding. So what you would do here, and Reese, you gave a great explanation. You do have to try to avoid these downturns by applying the regime filter again. That's why even on Twitter, I'm always saying, be careful about your regimes that you are trading. You can't be trading every regime the same way. So if you are long on a bullish regime, you are doing great. If you are long on a bearish regime, you get chopped off, like you did here, chopped out. You see?
So what would you add to this then, Pedro? What would you add if we were really, really dead set? And I've got a great question here I'm itching to share with you, which we'll do afterwards from one of the viewers. But if I was dead set on keeping this moving average crossover, but I wanted to refine it to a way that it could help me manage those drawdowns, what would I look to add?
Let's start with a simple solution. Let's add that the Bitcoin has to be above the SMA. Let's start with a simple solution. Let's say you want the Bitcoin to be above the 200 moving average before you take any trade. Maybe the 200 is too extreme, but it is a good filter. 200 moving average. And look, you avoid most of these downturns. Look, you didn't trade from 2018 until late 2019. You avoid these bearish regimes.
How did that play in statistically? What were we looking at? How did that manage the drawdowns better? Did we have more controlled drawdowns on that? Did it help? It must have done.
Yeah, it helped a bit, not much, but it helped a bit, 50%. The thing that it did was to reduce your trading and apply just capital to these regimes. What this does to you, you can compound your capital much better if you are not taking losses on the way down, all the way down. So there's still some things that you can do more, like a crossover by itself. It's not the best. We can get a smaller crossover to get better returns. We can try to put a bunch of filters on as well. But simplistically, your best bet is to always go for a regime filter. In SMAs, you have BPRO to also help with regimes. You have a bunch. You have to do that study, because if you are trading outside your regime, your account will be in great loss all this time.
No, yeah, absolutely. And actually, we've got a couple of really amazing questions here, actually. So there's one that's coming from Nuno and another one from Nblaze, who's a very, very good friend of the Nest and myself. So I'm going to share this up on the screen, Pedro. I'm going to drop this on you, right? I'm going to drop this on you, so you've got no idea what's about to come. But it says, are you building separate scripts for different time frames, meaning price action is fractal, but does it move in a different one in different time frames, needing a separate script? Now, Nblaze is studying price action with ourselves. He's a very knowledgeable guy. He's got a great interest in kind of systems and stuff as well. So if we were looking at it, for example, from price action teaching, what we would be looking at, we'd be looking at a higher time frame to set our bias, but then we wouldn't necessarily be changing our approach as we drilled into the lower time frames. For example, with my system, I'm looking for liquidity sweeps at key levels to either confirm reversals or continuation, right? Now, if I'm looking at that on a daily, that allows me to identify when a trend can be changing, yeah? And then if I'm then say to myself, I've got confirmation, say we've had a liquidity sweep, we break down and we break below the low, we have the market structure shift, yeah? Then I'm moving on to a lower time frame, but with the same approach. I'm then looking for that retrace on the lower time frame, the liquidity sweep, then for price to break down again. So what I'm doing is the master plan is done on the higher time frame, and then I'm using the lower time frames to pick the entries, but I'm following the bias of the higher time frame, right? So as we're applying that on here, and Emblazer just popped out a little change to it as well. He said in a different way, yeah.
Yep.
So are you building separate scripts for different time frames? Yeah, allowing for the fractal nature of price, or are you looking at this and you would be building different systems for different time frames?
Yeah. Awesome question. Let me just comment on what you just said. What you said
Mm-hmm.
can be a very good source of hedge from what I found from my testing.
Mm-hmm.
Going on lower time frames to try to pick your entry or your exit compared to your system can be a great source of hedge if you can manage those multi-time frame analysis, because you are relying on a faster time frame, and sometimes that faster time frame will trigger different types of exits, and that those the different type of exits can boost your performance massively if done correctly. But you are pointing out there's something very cool. For Nblaze question, he said not a different one, in a different way. I made a mistake in my question.
So that's it. So let me then ping the original question. Not a different one, but in a different way.
Yeah. Meaning price, but does it move in a... Yes, it does move in a different way. Nblaze, the lower time frame that you go, you can put it in an Excel and test the volatility of each time frame. The lower time frame that you go, the more noise that you'll find. What is noise? Noise is just a randomness of the market. In higher time frames, it's not that the market is more predictable, not that what I'm saying, but market can be followed way easier the longer time frame that you go. The less and less time frame that you go, the harder the market becomes, because the market is so random on those time frames. Take the example of 5-minute time frame. What stops me from going to the market and launching a $1 million or $10 million market order into the market? Nothing, and that will move the market. So the lower time frames will augment that noise ratio, and if you apply a trend following system to a lower time frame, you will experience very different results, if not completely negative. From my back, that's completely negative results. Not only to talk about, because Nblaze, this is not just a market question. You have to look at your own execution. This is also an execution question. How much fees will you be paying? A lot, compared to the volatility that you will extract from that trade. How much slippage will you get? If you are trading a $1,000, $5,000 portfolio, that's fine. If you are trading a 50,000, 100,000, now you get into troubles. So it's not only about market fractality, or that the markets move in the same way, which they don't, but let's say they did. You also have to take into consideration that execution will be much different. So it is higher cost to trade these time frames. Something to consider.
It's a brilliant answer, mate. Very, very good. Emblaze, I hope that answers your question. I'm sure it does. I've got an absolute beauty here from Nuno as well, which I think is exactly what another kind of thing that we want. So I'm going to drop the question, then I'm going to switch over to my chart for a moment while you manipulate, or not manipulate, but while you make this magic happen in the background. So I'm going to just run through people about divergences quickly, but this is the question here. Could you test code on a 15-minute EMA plus VWAP only when the EMA crosses above and is above the VWAP? Does that make sense? And is that something that you can do, or is that a little bit too complex?
No, sure, I'll try it while you explain the part that you're going to explain. Yeah.
So while Peds is doing all of that magical technical stuff, I'm going to take you back to the area of simplicity, right? This is how I trade. I'm looking for support and resistance. Now, I've got the current Bitcoin chart up, and within that chart, I have marked out key areas of support and resistance that I use, that I've shared, that I'm very public about them on Twitter and obviously at the Nest. Now, I'm not going to go into the reasoning behind it, give you a very quick overview of it, but for me, I'm looking what's capping the market, what's stopping the market going up, what's stopping it going down. They're key points of interest for me, because there's clearly buyers and sellers in those areas. Yeah. So when we set this high here, when we got rejected here, look at these long upside wicks, by the way, guys. When you're looking, don't ignore the candles. Candles really can tell you stuff like these. Look at the long downside wicks. It's telling you that there's buyers stepping in, right? That there's buyer pressure. The same way we get these clusters of long upside wicks, it tells you there's sellers pushing the market down. So what do we want to do? Like with anything, we don't want to take that at face value. We need to make allowances, and we want to make it as part of a system. So all I've done here is when we've run the price here, I'm saying that's a key level of interest for me. If we rerun this price again, I either want to see price break out, close above it, set a high, retest it, and then trade beyond it. In which case, I'm then interested in breakout plays above this high, right? I want confirmation. However, if we break back down within the range, if we imagine this is the high of our range and this is the low, then the point of interest for me is to go short. And when we're looking to short, if we're looking at a range-bound environment, talking about consolidation, then I'm targeting the far side of the range via the mid-range, the EQ, which is our 50%. So all I've done here is taken a Fibonacci, just with a 1, a 0.5, and a 0, and I've drawn that from high to low, giving us a midline. Now, as price is developing and as price is moving, I'm asking myself, okay, what can I add for extra confluence? So amongst its many features, and this isn't a sales exercise, this is all about just purely providing value for people, and hopefully we get some interesting points across. But I do use BPro, the Burbicator Pro, which is our in-house indicator. Now, I'm only going to show you one of its many features, which is its divergences. This uses over 10 different indicators and works out and works out divergences on all of them, giving you a percentage based on the divergence. Now, you don't have to use BPro. In my opinion, it's the most accurate one that I use, but you can use a simple RSI and you can tag these for yourself. And in fact, give us a shout out on Twitter, or drop something in the comments, or come and grab me at the Nest, and I'll share with you one of our cheat sheets that tells you how you can spot regular and hidden divergences. But as we've got this data in front of us, we want something else that's going to help us pull the trigger. Because as we pull into these areas, right, then if we look for our divergences, it can give us an idea of when we can get good entries. So I'm just going to pop on the BPro here. Now, my conditions are really, really simple here, right? And I'm going to fly through this in a couple of minutes, but you can come and grab me at the Nest or on Twitter, and I'd be more than happy to share it in more detail. But what I'm looking for, my parameters here, are we have to have interaction with one of our key levels, which is our range high, our midline, or our range low. And we need to have a divergence as well. And what I'm going to do very quickly is I'm just going to draw some squares around where we would look to take these trades, right? Oh, what if I do that? Right, so again, remember, in terms of this, what we're looking for is price has to be interacting with one of our levels. Right, so this one doesn't count because we're not touching it. These ones have all interacted with our levels. Right, so we're going to leave it at those. And do you know what? We're going to delete that one because that would have been our first test here. So that would have been the origin of this resistance level. So I'm now going to turn the BPro off very quickly, and I'm just going to drop you down to a lower time frame. Let's start with a 4 hour. And again, you could decant this down as long as you wish. But quite simply, what I'm looking for here is confirmation. So for my strategy and how I trade, I've got my divergence, which is a daily divergence, right? You can then filter that down further and you can add it on to help you spot other divergences. So this good confirmation, as is this, right? But let's move away from that for a second, just back to simple price action and say, okay, if we just look for a market structure break, we've got clear targets, high and low. If we're looking for our market structure break, we've got our divergence here. So what do we want to see? We've got our high, we've got our low, we've got our high, we've got our low, high. What do we get here? We get a structure break on this line, right? Personally, what I like to look for are liquidity sweeps. So whether you're talking about swing failure patterns, for example, what you're looking at here is this is a high. We've also got this high back here. Price has pushed up, taken out this high. Where I'm interested then in entering is looking at the low that sweeps the high. I have my own little geeky name for it, which is a breaker line, but basically it's the line that breaks structure after you've swept liquidity. And this gives us our entry, right? We're looking for then, price to sweep the high, generate liquidity, break down below the low that sweeps the high, retest this line, and then we're short with two very simple targets, our mid-range and our range low. All right? So then we're looking at the same here. We're saying to ourselves, right, we need to draw onto the lower time frames to find you a bullish example. So if we're stuck to the 4 hour, this doesn't give us a trade, right? But this one does, yeah? What we're saying to ourselves here is, here's the high, here's the low, right? We run either that low, or we can consider this low as our liquidity sweep, yeah? We're then looking for the high that sweeps the low, right? So we would take the high in here, and then we can get an entry when price retests. Now, you're saying to yourself, God, you've really got to live out a whole lot of chop here. But with our stop loss below the price swing low, fine, it takes some time, but price does then eventually build up and hit our target up here. All right. So just as a really simple way that you can use something like divergences and very, very simple support and resistance levels to help give you that extra confidence. And obviously you can draw that down into lower time frames as well. That helps give you that little bit of an edge. So I hope that's something you guys have found interesting. But what we're all really interested in, rather than me waffling on here, is looking at Nuno's question. So let me pass this back to Pedro, who's no doubt worked his magic in the background by now, and let's see what the master's got for us. What have you got, buddy?
Thank you for that explanation also, Rhys. It's all our different experiences that make a good trading system. So, so Nuno, right? You asked me that there was a scalping or a trading system on the 1 hour that you could buy when the EMA 15 was above the VWAP and the view. Yeah. So when the EMA 15 crossed above the VWAP, right? So I said if the EMA 15 crosses above the VWAP, and also if the daily time frame is above the 100 moving average, I applied here a simple extension to that. So to track regime, yes, it gives you a very positive curve since 2011 with over 500 trades. All right, but you have to take into consideration, again, slippage and fees into that. If you go to the performance summary, this concerns me here. We are not including fees or slippage. The average winning trade is only 1.63%. And also, if you notice, the trades is a system that requires some active trading, some active execution, fast execution. So those are all parameters that you have to take into consideration, both fees, slippage, and how will you execute. Because if you execute badly, you will destroy the performance of this strategy with such low percentage returns, average returns. You have to understand that it doesn't allow you for mistake. In trading, you also have to build a system that allows you to be flexible for mistakes. You know what I mean? Unless you have a very good structural algo trading behind you, and you can execute trades at a high precision.
Yeah, and that's a really, really good point, Pedro, as well. Something that we often don't take into account when we're testing strategies, right? When we're back testing strategies, is when we've got all the data in front of us, these things can look really, really appealing. What we remove ourselves away from if we're not using algorithms is the human element, right? It's the human element of, can you repetitively execute well? Not just well, but you can't pick and choose between those trades, right? You have to execute every time they go on. You need to be clean, you need to be concise, and you need to be accurate. And the little bits of elements of the human error come in, and they can undo a lot of hard work, which is why the difference between algo systems, I suppose, as well, and human trading kind of takes that side on as well. So, yeah, you're more than welcome, bud. That, as you've rightly pointed out, that was all Pedro's mastery on that. That really was. Look, guys, we're coming towards the end of our time together here, and I feel like with a few minutes left, we're not really going to get much opportunity to kind of take a deep dive into anything else. But I hope that what this session has given you guys is a little bit of insight into how you can test these strategies, how important it is to make sure that you're testing them with a lot of data. What you'll notice with Pedro, he's an absolute fastidious tester. He wants as much data as you can give him. He wants to test the robustness of the system as well. And one of the other things that strikes me with people when they test systems as well is make sure you understand your fee structure. If you're trading futures, you've got fees not just on the buying and selling of the asset, right? You've got fees based on, if you're using leverage, right? You've got your funding rate to consider. And all of those things, especially with trend following systems, if you're trading with the trend, the funding rate isn't going to be on your side, right? So you need to make allowances for that, allowances for these fees as they come in, because as they compound and you bring these errors into play, that's when you might have a relatively high success rate, but you're not noticing the returns for that success rate. Okay, so if I think, and I might have stolen this from Pedro, by the way, but if I was to leave you guys with one thing, then I would say this, actually. I would say that indicators aren't a silver bullet, right? There's something that you need to use in conjunction with price action and with a good knowledge of the market. I think it's very, very important you find a good community of traders, people that are willing to share their experiences with you, people that are willing to learn with you, educate you, somewhere you can ask questions, right? And you can build this knowledge in the background. Now, our slogan for this whole event is the best time is now, and that's for a reason. That's because if you're a trader, if you're a systems builder, algo, whatever it is you're doing, you have a very, very good opportunity right now to be learning as much as you can, refining systems as much as you can, preparing yourself. If you're someone that's looking to trade the next bull market and that isn't looking to trade this market both ways, you have this golden opportunity now to really double down on your learning, right, and make sure you're really, really fully prepped. So I think that's my parting comment for you guys that I would focus on. Pedro, what do you have, mate? I know I'm putting you on the spot here, but if you had to give a parting bit of advice for our viewers, what would you impart?
There's a lot of different ways to trade. All of them can be brilliant. All it matters is your performance at the end of the day. I would say that your best bet is always to test. You don't have to be fully systematic or algorithm, of course not, but try to test as much as possible what you can test.
Awesome. So to wrap this up, guys, I have got a giveaway code for you all right? Secret giveaway code. You can find the details for this down in the description. I'm going to flash this up on the screen once more before we disappear. But just before I do and we say goodbye, I just want to have a very quick word from our sponsors.
Milk Metaverse is a metaverse platform for the media industry that will bridge the gap between the content producers and the audience. Mediaverse from Milk Platform will be a combination of virtual reality, blockchain technology, and artificial intelligence. Visit the website metaverse.milk.global.
Awesome, and thank you so much for that, Milk Global. So, as promised, guys, you can see going along with the little banner along the bottom, we have an exclusive giveaway and the link, so you can find all the information in the description. But what you absolutely need is the code, right? So for those of you that have stuck with us all the way to the end here, this is your reward. Write that code down, follow the link through the description, all right, and you can get yourself into an awesome prize giveaway. These are happening every day, guys, all right? So do pop along, stay involved, do send us your comments and your feedback, what you think you can do better, what you've really enjoyed, and that'll all get played into how we refine and make these even better for you guys in the future. So from me, I'd just like to say a huge thank you to everyone that tuned into this live, and a big shout out to everybody that couldn't make it live but is going to be watching this on recording. I also have to say a very big thank you to our absolutely amazing co-host here in Pedro. Please do give him a follow in Pedma7. And yeah, if you're interested in algos and bits and pieces like that, guys, I've not come across anyone better. So thank you very much for your time. Pedro, would you like to say goodbye to the folks, and we'll sign this off?
Goodbye. Hope you enjoyed it.
Awesome. Take care, guys, and we'll see you at the next one.